Hey, Brian Bogner and Greg Towner here. Want to talk to you for a few minutes today on where we are at right now with the markets and the economy. A lot has changed since we did our last video, and we want to get you up to speed on what we're seeing and what we're thinking. So let's go ahead and get started. Greg?
Yeah, thanks, Brian. This is a one-year chart of the S&P 500, but mostly we want to look at what's been going on here in the last few weeks. Last time we talked, we said that there was some interesting signs that you sometimes see around a market low. We got the most historic oversold, sentiment was really negative, some of the internal data we look for was coming through. And now we've started to see the market move higher off its lows. This blue line there is actually the 20-day moving average. We don't use that a lot because it's a little shorter term, but in a fast-moving environment like this, it's nice to see the stock market surging over that, giving a little indications that we've seen some sort of bottom. Whether it's the bottom, time will tell, of course. We've taken out those highs from a couple of weeks ago. So there's some positive things happening here that the market seems to be discounting the worst case scenario, whether that's economically, health-wise, what have you. Doesn't mean that there's not a lot of tough days ahead, but I think the market's taking off the table, hey, the worst case scenario is less likely at this point.
Yeah.
Yeah, and we put that arrow on there to indicate something very important. So look to see where that is, see what the market did both that day, a big surge higher, and then since then. And then let's go to the next chart, Brian. This is the jobless
Wow.
claims numbers. Yeah, I mean, that bar on the right, it almost looks like it's part of the border of the chart, not the actual data itself, right?
Right.
So this is the data that came out, the first jobless number that came out. There's been another one since that almost doubled this. But that arrow on the chart indicated the day that this number came out, the market was up over 6% that day. We've gone higher since then. So again, the market discounts economic data ahead of time. The market's bottom well before economic data bottom. So we just wanted to put this in there. Doesn't mean economic data is not going to be bad. It's going to be real bad. I think the big question is for how long that will be the case. And we'll see as time goes along. But the market has discounted a lot of bad data already. I mean, we were down on the S&P about 35% at the worst. And that's just in the S&P. Other indexes were worse than that.
Yeah, the market's been rising on some bad news, no doubt, and that's always a good thing there. Going to this next chart, and hopefully this is some good news. All this is, it's really just two things. Like the black lines are just total number of cases. This is globally, but this does not include China. We're not including China in these numbers for obvious reasons. And this is just here in the U.S. And then what the blue line is, it just means the rate of change, okay? So what we're seeing is even though cases globally and in the US are still rising, what's happening is the daily percentage growth is declining, which means that we're likely going to see a peak here sooner than later. And in some models and things like that, it could potentially even be, middle of the month. We don't know. These are just models, things like that. But if you follow the trend, so the point is, this is good news. Okay, that this growth that we've seen, that the self-isolation, the stay-at-home, these things are actually working right now, and the growth rate is declining, which is positive.
What's not declining is the Federal Reserve's balance sheet. It's going straight up. I mean, the speed and size that they have moved dwarfs anything that happened during the financial crisis, and they will keep doing it. So what has this done? It's stabilized credit markets, currency markets. It's helped stabilize stock markets. This can't fix a health crisis, but it can help get people from here to the other side of that. And then post the crisis period, there's going to be a lot of liquidity in the market. So the Federal Reserve continues to increase their balance sheet.
Right. And Greg, this is just what the Fed is doing. This does not include the $2 trillion stimulus that's gone through. And I know there's a lot in the headlines right now about the payment protection plan and some of the unemployment, some of the struggles there and things like that. But the reality is that money it may be delayed, but it's still going to get through. And if I'm a betting man, right, I'm betting there's going to be another package that goes through. Now, what that dollar amount is, I don't know, but it'll probably be very significant. So you've got world central banks that just raised their balance sheet up significantly, and now you've also got Congress here putting out a significant amount of money. And the point is, there's going to be a significant amount of tailwind in liquidity and money here very shortly.
There's been a lot of talk about what's going on right now, and understandably so, but sometimes it's good to take a look at the really long term. This goes all the way back to the 1920s. Cumulative stock market returns. The blue is during bull markets, and that red, those little areas on the bottom, are bear markets. So it's important to keep in mind, just from a historical perspective, why you want to be long stocks, much more so, and not panicking and getting out, because those bear markets, they're painful. They don't feel good, believe me, but they're very brief in time when you look back. So when this one will be over, time will tell. But historically, the up periods are significantly larger and significantly longer than the down periods.
Yeah, and I think this is a good chart to end on. Just even the fact too that what makes these, you look at this and you go, well, wow, why was I so concerned back when the tech bubble blew, or when we had the great crisis in '08 and things like that? Because even in these short amount of times, there's so much uncertainty and there's so much negativity, and emotionally we get pulled in and drawn into that, and we feel horrible. Okay, and so even though these times are short, it's what affects us, right, the most emotionally. But taking a step back here to Greg's point and seeing that, this is the reality of how things happen over time, and we need to remember that when we're going through this. So just wrapping it up, markets have taken the worst case scenario, we believe, off the table for now. We are considerably higher off those lows at this point, so that's a good thing. Economic data is bad and will continue to be. For how long? We don't know, but we're about to enter earnings season as well here this month, and we believe this next month there's going to be a lot of bad headlines. If the market can digest that and hold and even move higher, that gets us more bullish. Okay, so it's already digested a really bad unemployment number, and it moved higher from there. The Fed is pumping massive liquidity in the financial markets right now. Congress is putting stimulus in. When things settle, there is a massive tailwind of money and liquidity that is going to be there when that happens. And finally, again, just perspective, the duration of bear markets is historically very small compared to bull markets, and we need to keep that perspective as we're going through this time. So you know how to reach us, you know where we are. Thanks so much for listening today, and we'll talk to you soon.